Assalamu alaikum and good afternoon, everyone. I would like to welcome you all to the MSX Discussion Session, where we'll be discussing the financial statement, financial performance for the first half of 2025. Joining me today is our acting CEO, Mr. Gopa Kumar, our Chief Executive Officer, our Chief Islamic Banking Officer, Mr. Amir Al-Amri, and our Chief Financial Officer, Mr. Vikesh Mirani. Along with me today, I have our Investor Relations team, our Head of Investor Relations, Hilali Arabi, Sundus Al-Lawati, and myself, Maram Al-Hadrami. As the bank continues to focus on expansion opportunities through the increase of footprint, our branch network has now reached to 141 branches, combined with the expansion of our digital channels. Bank ظفار is a fully fledged commercial bank, including an Islamic window of over 700, with serving over 700 retail customers and a wholesale corporate customers of 4,700,000, with a robust capital position and strong financial performance. With this, and to discuss our financial performance in detail, I will now pass it to our Chief Financial Officer, Mr. Vikesh Mirani, to take us through the investor presentation.
Welcome to our first half of 2025 earnings call. We will be covering, as you can see on the slide deck, our agenda would essentially cover the highlights and the key financial performance for the first half of 2025. We will look at the operating environment where we operate in. We'll deep dive into our business strategy, looking at the digital banking and some of the ESG initiatives that the bank has undertaken. We'll then be looking at the financial performance in detail, both for the conventional as well as the Islamic banking. And with that, we'll conclude the presentation and open it up for Q&A. I will immediately jump to slide number 4, which shows Bank ظفار at a glance as at the end of 30th June 2025. Our total income stood at 84.46 million, which is an increase of almost 8.1% as compared to the same period last year. Same period last year, June 2024, our total income stood at 78.1 million. Our net profit for the first 6 months of 2025 stands at 23.67 million, which is higher by 7% as compared to the same period last year. Our net loans and advances and financing to the customers stood at 4.17 billion, which year on year grew by 11.8%. And if I am to compare it with December 2024, grew by almost 6.1%. Deposits at 4.03 billion is higher as compared to last year's same time by 13.6%. And if I have to compare it to December 2024, it grew by almost 7.18% and continues to be a good story. Most of the deposit growth comes from the increase in savings deposit, which has grown by almost 19.9%. And we'll be covering that subsequently in my slides. Total assets stood at 5.32 billion. Cost to income ratio stands at 48.19%. Our ECL coverage ratio as at the end of June 2025 stood at 95.46%. This has increased as compared to the last year. Last year, same time, it was at 89%. End of the year 2024, it stood at 94%. Capital adequacy at 16.42%. Fee to income ratio continues to be a good story, and I'll throw some more light and context around it in my subsequent slide. Stands at 29% in the first half of 2025. Our return on average shareholders' equity stood at 8.32%. And if I am to adjust this for the additional tier 1, which is at 155 million, my return on equity adjusted for 81 stood at 6.55%. We have 15 nationalities working as full-time employees with our bank. 44% of that are women employees. We have one of the fastest growing branch network in Oman, as Maram mentioned. We are now at 141 branches, 112 branches for conventional and 29 branches for Islamic. We are rated by both Moody's and Fitch. Moody's very recently upgraded us at investment grade at Baa3, and Fitch rates us at BB+. Moving on, next slide shows the geographic expanse of our branch network. As I said, 141 branches spread across the country in Oman, 112 of which is conventional, 29 Islamic. Our branch expansion or branch growth journey has been phenomenal, from 64 branches in 2022 to almost 141 branches now. This is an increase of almost 58 branches, both conventional, which saw an increase of 58 branches, and Islamic, which saw an increase of 19 branches over the last 3 years. Our total ATM network, CDM and MFK network stood at 356, 178 for cash deposit machines and 4 multifunctional kiosks. Our market share in terms of assets, loans and deposits stands at 12% for assets, 13% for loans and 12% for deposits. We service almost 747,000 customers. This again has been a significant growth story for the bank. Somewhere close to 2022, we were a shade about 200,000 customers. Now we stand at 747,000 customers, with 600,000 customers in our retail business, 47,000 in corporate and SME. Our DHOFAR Islamic services 99,000 customers, totaling to 747,000 customers. Some of the awards, etc., that we have won in the first 6 months of 2025. The fastest growing branch network in Oman from World Business Outlook, Best Bank MENA 2025, Gazette International, and Best Customer Centric Banking Brand by Global Brands Magazine UK. Moving on, next slide shows the balance sheet, the P&L, as well as the key ratios. Our balance sheet, what you can see on the top left, our net loans and advances, as I just mentioned, from 3.7 to 4.174, an increase of 11.8%. Investment securities from 530 to 672 million, an increase of almost 26%. Customer deposit continues to be a good story, an increase of almost 13.6% from 3.5 to 4.033 billion as at the end of June 2025. Looking at some of the P&L income statement numbers, operating income from 78.2 to 84.5 million, an increase of almost 8.1%. Operating expenses from 37.8 to 40.7, an increase of 7.8%. My profit before impairment and tax was at 43.8 million, an increase of 8.3%. Impairments increased by 8.4% at 16.2. Net profit as a summation of all this at 23.7 million, an increase of 7%. Some of the key ratios: total capital adequacy at 16.4, which I just briefly touched upon in my previous slides. Our core capital CET1 ratio stood at 11.9 as against the regulatory requirement of 9.5. NPL ratio at 4.75%, improved as compared to the same period last year by 36 basis points. Return on shareholders' equity at 8.32, adjusted for Tier 1, additional Tier 1 at 6.55%. Return on assets at 0.92%. Our net interest spreads marginally declined by 5 basis points if I am to compare it with the same period last year. Last year, June 2024, the net interest spread was at 227. As at the end of June 2025, my net interest spreads stood at 2.22%. Cost to income ratio continues to improve at 48.19%, and net loans to customer deposits stood at 103%. Next slide shows the performance trajectory over the last 11 years, particularly if I were to focus on period post-COVID. The bank continues to increase all three, which is total income, operating profit, as well as net profit. And the first half of the first half of 2025 results is what we are discussing today in our earnings call. Moving on, this slide shows the shareholder structure and our asset composition. We continue to be owned by both government and protection funds to the extent of 28%, creating a good, strong, sticky relationship with our government entities. In terms of total assets split as well as operating income split, we have a well-diversified business streams across all our 4 businesses, which is retail banking at 26% in terms of total assets, wholesale banking at 41%, treasury and financial institutions at 14%, and DHOFAR Islamic at 19%. Pretty much the same gets mirrored as far as my operating income is concerned. Corporate banking generating an income of 39%, retail at 30%, treasury and financial institutions at 14%, and DHOFAR Islamic at 17% in the first half of 2025. Next slide shows the key historic evolvements for Bank DHOFAR since inception in 1990. I'll just focus on the first half of 2025. We raised 31 million in Tier 2 subordinate debt earlier during the year. As we've just mentioned, we now have 141 branches spread across the country. We also did a successful acquisition of the Bank of Baroda Oman branch in the first half of 2025. This presents a significant strategic partnership opportunities at the financial institution stage for us with Bank of Baroda, as well as some of large acquisition in terms of NRI customers that are now banking with us. In terms of overall customer numbers, if I have to look at retail, we acquired almost 6,500 customers, and if I have to look at corporate and SME, over 700 customers were onboarded through this acquisition. Moving on, some of the key strengths: we continue to be a leading franchise in Oman, offering all banking business, including retail, corporate, treasury, Islamic, private banking, wealth management, and corporate advisory services. We work very closely with government and protection fund, providing us with a strong government sovereign support. We operate out of a stable, growing operating environment in Oman. We clearly enjoy a solid, robust capitalization at 16.4% for our total capital adequacy and 11.9% for our CET ratios. As I mentioned, a very well diversified and smart distribution channel with a very expanded geographic footprint of 141 branches, and experienced and seasoned management and our staff who support the growth of our business. Looking at the overview of Sultanate of Oman, and again I'll very quickly run through this. We are the second largest country in the GCC with a stable political system, population of upwards of 5.5 million, working towards the Vision 2040, which is the vision of Government of Oman. In terms of our real GDP growth, estimated for 2025 is expected to be 2.7%. The sovereign is rated by all Moody's, S&P, and Fitch at Baa3, BBB-, and BB+. Moving on, looking at the Omani banking sector. The banking sector comprises of 20 licensed banks, 16 of which are conventional, 2 state-owned specialized banks, 2 full-fledged Islamic banks. The total banking assets as at the end of May 2025 stood at 46 billion, deposits at 32, and loans at 34 billion. If I look at Islamic Bank assets stood at 9 billion, and Islamic Bank continues to be the fastest growing in terms of overall growth in assets over the last 5.5 years. It has achieved a CAGR growth of 10.53%. I'll spend some time on our strategy and give you some perspective and the thought process behind what we are doing. In terms of our purpose, we are a bank that is very relationship led with over 141 branches Our RMs, our customer service representatives, our management has a very broader reach to our customers. We are a bank that we believe we are easy to deal with. Over 95% of our customers which are serviced at the branch channels are serviced within 10 minutes and 98% as far as Islamic banking is concerned. We do offer extended time in some of our branches to allow our customers extended time to bank with. Thinking long term, of course, we have been in business in 1990 and clearly working with our customers over a longer period of time is clearly one of the key aspects of our strategy. A responsible and secure bank, fundamentally, this is quite critical to us, both in terms of the information technology, the information security spend, ensuring customer privacy as well as data security for our customers. With expanded branch network, some of our key strategic pillars includes digital engagement. Our internet banking, mobile banking offers a very different experience in terms of changing of debit credit card pins. If you are to use our digital channels, even changing our credit and debit card limits is something that you can do on our digital banking channels. Customer centricity is at the heart of our decision making. Is just not a buzzword. Over 95% to 99% of our customer complaints are resolved and addressed within the given SLA time. Promoting strong performance culture and delivering strong operational excellence continues to be one of the key focus areas for the bank. Adopting future-proof technology, and I can give you some examples. We are investing in our digital engagement hub to continue to improve the customer experience. We are looking at a new core banking solution for our Islamic business, investing in cloud-based technologies to improve turnaround time and customer service continues to be a key focus areas. In terms of our priorities, I talked about the enhanced digital engagement through our omni-channel as well as other digital channels continues to improve our customer experience. Acquiring more customers, I talked about the expanded branch network, the digital channels that we have now, we are offering to our customers is something, plus the improved customer service experience, which has allowed us to expand our overall customer numbers from a shade about 200,000 to 747,000 as at the end of June. Focus on simplifying operational processes as well as improving and achieving a healthy cost to income ratio continues to be our desire. You would have seen whilst we have expanded our branch network and invested significantly into new businesses, new departments, my cost to income ratio over the last 3 years continues to improve and now stands at 48%. It was at 57% just 3 years ago. We continue to prioritize our ESG initiatives across our businesses. Some of the key items or areas that we are focusing on, for example, you would have noticed the introduction of hybrid electric cars in our Muscat region. Again, ensuring our environment-friendly initiatives. This is something that we will expand to our other regions as well slowly. Other CSR initiatives as well as environment and social cause initiatives is what the bank continues to look at and invest in. Use of data, analytics and technology to improve both customer service experience and performance continues to be an area that the bank focuses on. Our Voice of Customer program enables us to deliver a better customer experience for our customers. We follow a disciplined risk management approach, investing in information security, as I talked about, as well as improving and increasing awareness within the organization is again an important area that the bank continues to focus on. Our people and HR practices are again a center stage when it comes to operational excellence. Over the last 6 months, we have completed almost 5,000 e-learning for our staff. Over 1,757 Instructor-led training sessions were conducted by our HR department. Our Ruad program attracts and onboards fresh graduates. We have also launched Twaji, our leadership program, to develop our upcoming leaders in the organization.
So if there is one slide that I would like you to focus on, it is just this slide. Every single word that's put out in this slide is really what drives our business and drives our strategy, drives our actions. So I just thought I'll let you know that. Thank you.
Thank you. Moving on, so I talked about technology, I talked about data, relationship management, performance, our operational excellence, and as Mr. Gopa mentioned, these are not just words, but clearly strategy that we are adopting and applying, and this is what it really translates into. We are able to now, with the use of technology and operational excellence, etc., are able to serve our customers within 10 minutes. Over 96% of our customers were served in the conventional branches, and over 98% of our customers were served within 10 minutes in our Islamic banking business. And this is statistics that we follow every week, and continue to improve on this as far as our customer experience is concerned. Moving on, this slide shows the ESG initiatives that the bank has adopted. We have formed a sustainability office within our strategy setup, and this continues to be an important focus area for the bank. We have published, and you can see that on our websites, sustainability reports for the year 2023 and 2024. We continue to prioritize our sustainability initiatives, and this is again in line with the 2040 vision, an important area that the bank is focusing on. Moving on, this slide shows the segmental split of my net profits, operating revenues, as well as some of the key segment highlights. As I mentioned in my previous slides, my retail banking at 30%, corporate and wholesale at 39%, treasury at 14%, and Islamic banking at 17% was the overall contribution to the top line. In terms of retail business, we serve 600,000 individual customers, offering them a diverse range of products, serving priority banking, private banking, premier banking, which includes Al-Rifa, Al-Riyada, wealth management, youth, ladies, and student banking. Over 47,000 SME corporate banking customers are serviced through our wholesale banking, corporate banking business, in which we are offering tailored services to our large corporate customers, project finance, syndication, and other corporate banking facilities. Our government banking unit focuses on deposit mobilization from government and quasi-government entities. Treasury and financial institutions manages funding, liquidity, and offers various products to our clients, which includes money market, currency swaps, interest rate swaps, options, and plain vanilla currency transactions. DHOFAR Islamic services over 99,000 customers, offering them Sharia compliant products, and again covering all parts of business, which includes retail, corporate, treasury, and investment banking services. I have broadly touched upon some of the key digital banking initiatives that the bank has undertaken. So whilst we invest in expanding our geographical footprint, digital banking is again a space where the bank continues to invest. We have launched multifunctional kiosks, which allows our customers the statement printing, checkbook issuance, as well as debit card issuance facilities. Launch of DHOFAR Pay, Samsung Pay, Apple Pay from our mobile devices. New soft POS for customers allowed us to expand our POS network very quickly to various merchants. A new mobile banking app, WhatsApp services, as well as digital onboarding of customers is again an area that we have invested in. Direct API integration with ICICI, and internet banking for international remittances is again an area that the bank has invested in. I talked about enhanced card management services on our digital banking platforms, which includes resetting debit and credit card pins, as well as changing the credit and debit card limits that can be achieved through our digital banking channels. I will now deep dive into our financial performance. Our consolidated P&L, our net interest income stood at 59.94, very marginally lower as compared to the same period last year. As I mentioned, our net interest margins have marginally declined from 227 to 222 as at the end of June 2025. This is on account of the 100 basis points cut that was seen in the last year, in the last quarter of 2024. Some of the asset yields have declined slightly ahead of the overall reduction in the cost of funds. Fees and other income continues to be a brilliant story with a growth of almost 37.7%. This growth in its entirety is coming from my core businesses as well as transactional businesses, and I've got a separate slide that touches upon that. My overall cost has increased by 7%. Now you would have seen the cost increase in prior periods was ahead of the market. In fact, last year it was at 14%. This was clearly because of the investment that the bank was doing or has been doing over the last 3 years, both in terms of branches as well as new businesses. This increase in pace has now slowed down to 7% and now pretty much in line with the market. Our operating profit stood at 43 million, an increase of 8%. Net provision, which is the cost of risk, stood at 16.19 million. My overall cost of risk is at 80 basis points. It continues to be higher, and as the guidance that we had given in our previous call, we expect this to be in the same range of 70 to 80 basis points as we de-risk some of our legacy exposures, after which we expect this to decline. Our net profit as a summation of all this stood at 23.67 million as at the end of June 2025. Looking at Islamic banking numbers, our operating income again pretty much mirrors the same story as conventional, an increase of 21%, stood at 14.47 million. Fees and income, other income at 22.2% at 3.61 million. Net impairment losses on account of some of the legacy exposures that I talk about, which is also having a bearing on my overall cost of risk, essentially emanates from Islamic banking, and we continue to make prudent provisioning in our Islamic banking business at 5.25 million, because of which my overall profits, net profits, declined as compared to last year, particularly in my Islamic business at 1.93 million. In terms of overall balance sheet growth, our financing increased from 730 to 810 million, an increase of almost 10%, with both wholesale and retail banking business growing. My customer deposit continues to be a very good story as far as Islamic banking business is concerned. The Islamic banking branches went up from 10 to 29, which is almost 3 times over the last 3 years. This is clearly getting reflected in the overall increase in my CASA balances. This is again something that's a wonderful story. My CASA balances in Islamic business standalone went up from 40% to 53% year on year in the last 1 year. Most of the growth again in my overall CASA comes from both savings deposit in conventional and overall CASA increase in my Islamic business.
Yeah, I will just give a short brief about DHOFAR Islamic. DHOFAR Islamic has been established 2013, known that time at Maysara Islamic Banking Services. So till December 2023, we have decided to rebranding to DHOFAR Islamic. And the branches in it were grown from 10 branches as today 29 branches. So regarding the CASA, because of the expansions and the branch expansion in the country, we increased the CASA deposits. As our CFO mentioned, we reach in the deposits we stand today at 803, and this is which is the successful story of DHOFAR Islamic in terms of increasing deposits as overall in CASA and all in other deposits as well, in terms of corporate and SMEs and all other deposits as overall.
I will now take you to the overall gross loans and advances. I did touch upon this. 11.8% is the overall growth. You can see the growth is coming from both wholesale as well as the retail business. Some of the key areas where we've grown in the businesses or the segments where we've grown in retail at 114 million. trading, manufacturing, even government and quasi-government institutions at 153. So we've seen increase in our overall loans and advances across all our businesses and segments. This slide, which is slide number 21, covers the credit quality. What you see on the top left is the NPL, both in terms of absolute numbers as well as the NPL percentage. NPL percentage gross stood at 4.75% as at the end of June 2025. It peaked at 5.87% as at the end of 2022 and has since declined to 475. Our stage 2 exposure stood at 776 million as compared to 840 million in 2023. Again, in terms of the overall coverage on stage 2 stood at 10.21% at the end of June 2025. My non-performing coverage stood at 95.46% and my stage 3 coverage ratio at 52.83%. We did write off some of our NPLs last year and earlier during this year, which has resulted in a coverage ratio of 52.83% as far as stage 3 is concerned. And as I mentioned, with an elevated cost of risk associated with my book at 70 to 80 basis points, we plan to improve this in the next 3 to 4 quarters. Moving on, funding and liquidity, again, as I mentioned, a good story at 13% increase year on year, coming both from CASA and term, largely from CASA, and that too from our savings deposit, which went up by 19.9%. We also saw market share gain as far as our saving deposit is concerned, and we continue to aggressively pursue our strategy on improving our CASA in the coming quarters. This slide shows profitability, and the chart that you see on the top left gives a split of our NII coming from conventional, our profit income coming from Islamic, as well as the fee income from all my businesses. As I mentioned, our fee income continues to be a good story. This is something that we continue to aggressively push for. I have given this guidance in my earlier calls. Our fee to total income ratio was low of 14.5% earlier in 2022. The fee income continues to be our top focus areas and now stands at 29% as at the end of June 2025. Be it retail, corporate, treasury, financial institutions, Islamic Bank, our trade business continues to contribute to our fee income. We started with some new business opportunities such as private banking, wealth management, corporate advisory in the last 1.5 years, and that also has started contributing to my overall fee income. As I mentioned, fee increase has largely come in from my core businesses, and that is reflected in the table on the bottom left of the slide. Our net fees and commission income last year, which is 2024, for the full year stood at 28.5 million, which again is my core business, stands at 16 million in the first 6 months of 2025. Miscellaneous income, which is largely the other income, at 1.2 million last year and 1.1 million for the first 6 months of 2025. My overall FX, which is largely transactional-led fees and investment income, stood at 7.2 million in the first 6 months as compared to 8.8 million for the full year 2025. Moving on, operating expenses, whilst in terms of operating cost to income ratio peaked at 57% as at the end of 2021, continues to decline and stands at 48.2%. Clearly, whilst we made significant investments into our business and technology, including some of the new businesses that we had set up, required investments into the business, which led to a higher cost to income ratio, which is now slowly coming down. We expect this to gradually come to market levels in the next 3 to 5 years as we continue to improve our operational efficiencies as well as gain top line momentum. Looking at our yields, cost of funds and net interest margins, if I compare it with December to June 2025, my asset yields have declined by 24 basis points. This is on account of some of the pressures, of course, that we are seeing on our asset yields, which has come after the reduction in our overall interest rates, Fed rates over the last quarter of 2024, wherein we saw a 100 basis points decline. In addition to that, our loan growth has come in from mostly government, sovereign and quasi-sovereign businesses, as well as retail businesses, leading to a 24 basis points decline in yield. This is in fact also being seen in our overall cost of funds. If I compare it with December 24 to June 25, my cost of funds in that period has declined by 37 basis points from 4.14% to 3.77%. Clearly, it's not only the reduced cost of funds on account of repricing of term deposits, even the increased saving deposits and CASA, as well as the increased CASA in Islamic banking is driving down the cost of funds. Overall net interest spreads, if I compare it with December and June, there's an increase of 13 basis points. However, if I have to compare it with June of last year to June of current year, it's a marginal 5 basis points decline, as I mentioned in my previous slides. Looking at the capital position, the bank enjoys a healthy capital adequacy ratio of 16.4% and a CET1 of 11.9%. My total risk-weighted assets as at the end of June 2025 stood at 4.4 billion, and the bank has a history of dividend payouts. Last year, which is for the year 2024, the bank declared a dividend of 8%, which included 1.45% of stock and 6.55% of cash dividend. With this, I'll conclude my presentation, leaving you with some of the key thoughts which I've broadly covered in my presentation, and with that I will open this for pass it back to my investors relations team. So my fee to income ratio, a wonderful story at 29%. This is a guidance that we have given to the market over the last 2-3 years. Continues to be a focus area, and we continue to improve on this. Our net profit increased by 7% year on year. Our CASA ratio continues to be, again, as I said, a key focus area, stood at 48%. The growth coming both from savings deposit as well as Islamic business. Our geographic footprint expansion through expanded branch network stood at 141 branches, 112 conventional, 29 Islamic. We continue to have an experienced management team focused on driving performance along with a very experienced staff which is delivering operational excellence for our businesses. With that, I will pass this back to my investor relations team, and we'll open this up for your questions.
Thank you, Chief. We'll be starting with the... And if anyone has any questions, please raise your hands. Yes, Mana.
Good afternoon.
Hi, good
Thank
afternoon.
you for your presentation. I have just a few questions. My first question is that the net loans that you mentioned have increased by 11% and 28%. So what are the key segments contributing to the growth? Can we expect this pace of growth to continue in the second half as well?
Thank you, Mana. Thank you for your question. And as I had covered in my slides, the net increase in the loans, which is at 11.8% as compared to June of 2025 or 2024, and almost 6% from the start of the year, is broadly coming from our retail business. Our retail business saw an increase of 114 million. Trading, manufacturing also contributed to an increase of 48 and 49 million respectively. Our loan growth has also come in from some of the government and quasi-government initiatives that we have participated into. In fact, almost 153 million of increase came from from that sector. In terms of our outlook, as I had mentioned earlier during the year, we do expect this to be in the high single digits. So, whilst I look at June 24 to 25, it's 11.8%. First 6 months, it's been around 6.1%. Towards the end of the year, we would expect this to be upwards of high single digit growth.
Thank you for the answer. Just 2 more questions. As you mentioned, Islamic financing has been growing steadily.
So Islamic banking, whilst my overall book is at 3.9 billion, if you look at Islamic business stands at around, in terms of absolute numbers, stood at 736 million. So it's coming from a smaller base. So overall, we would expect Islamic business to slightly outpace the overall growth in conventional book. But in terms of absolute numbers, you would continue to see higher numbers coming from the conventional business. Clearly, in terms of the opportunity, and given we operate both the conventional business as well as the Islamic window, we look at customer requirements and then are able to provide both the conventional as well as Islamic business solutions to our customers, expanding both the product reach as well as the nature of products that our customers really require.
Okay, understood. And also in the first half, the other operating income also was high. Like it has increased from 3.2 to 4.4. So what was the reason for this? What was the other operating income?
See, as I mentioned, other operating income includes some of the miscellaneous fees, which again forms a small part of around $1 million. In addition to that, we also have FX income, which is shown at that, which is largely transactional led. So with the expanded customer numbers that we currently work with of 747,000, largely the FX income which is getting generated from our SME, corporate and Islamic business is what is leading to the increase in the operating income, other operating income.
This is going to sustain.
Yes, we do believe so. As I mentioned, since most part of it is FX, we expect this to be sustainable.
Thank you for your answers. That's it from my side.
Thank you.
Our next question, Bishan, go ahead, please.
Hi, good afternoon.
Yes, Bishan.
Good afternoon, Mr. Brani. Thank you so much for the presentation. Congratulations on a good set of numbers. Just a few sort of observations, comments from my side. You spoke about loan growth, and it's interesting you mentioned one of the key areas was retail. If I look at the segmental breakup, as of June, and I'm talking of retail banking, if I look at YOY basis, we've seen a 6% growth in loans and a 21% growth in deposits. And on a YTD basis, I think that number is a slight decline. Can you just comment on that?
In terms of retail business, clearly, over the last 6 to 12 months, Bishan, our strategy as far as branch expansion was broadly focused on liability-led growth. And that's why, I mentioned we have grown our savings deposit by over 19.9%. But again, whilst we continue to focus on our liability-led growth, we have also now focused on focusing aggressively, or rather focusing on our retail loan growth as well. So, the overall growth on the liability, continues to be a key focus area. So that's the reason why you see a higher liability growth as compared to the loan growth as far as my retail business is concerned.
Understood. Fine. Okay, that makes sense. I can already see the profitability flowing through on the retail banking side. You have a net profit of 3.8 billion for FY24, and for 6 months that number is already at 6 million. So I can see the growth there. So kudos to the team over there and the strategy of branch expansion, which is against conventional sort of approach. So congratulations on that. You spoke about your net interest margins and the spreads, and that is not mistaken at 2.22 as of June. What's an aspirational number when you look at your peers and the market? And I understand, there's a reason why it is where it is compared to competition, but with the initiatives you've taken and the focus that you have, what sort of aspirational number do you have, and sort of what's the goalpost in terms of the time frame to achieve that? Because that would be a key determinant on the core business side to achieve a higher profitability, ROE, etc. Right?
Thank you, Bishan, and yes, it is 2.22% as at the end of June 2025. If you ask for my aspirations, clearly, we need to go, a step up on these numbers. And there are various, strategies that the bank is deploying to get there. I wouldn't want to put a number, but if you look at my 2021 numbers, 2022 numbers, our total net interest margins used to be 2.51%. So, expanded CASA is one area that is definitely going to help us deliver that strategy. In terms of our overall, managing of our liquidity is again an area that the bank continues to focus on. So that's again an area that the bank optimizes in terms of improving the overall yields and overall net interest margins. So in the short run, with the volatility that we will probably be seeing as far as our interest rate environment is concerned, I do expect a marginal decline because as the interest rates go down, the overall yields tend to come down at a faster pace as compared to the overall cost of deposit, because the term deposits have their own maturity timeline. But in the longer run, with the expanded CASA as well as the overall liability led strategy that the bank is deploying and reducing its reliance on the high cost deposit, I expect my overall net interest margins to improve from this range.
Sure. Now, this is more of an academic sort of query than an observation. Historically, what we've seen at the peak of the interest rate cycle was that there was almost very little difference between what a sort of current account or current account was yielding versus, let's say, a term deposit. And some of the banks had a decision to make in terms of offering high rates to customers, but not having flexibility of retaining that money when sort of the interest rate cycle turned. And part of the decision was to probably convert it into term deposits. Anyways, paying within a very limited margin of what the call account was yielding. But at least having comfort of having those deposits locked in for, let's say, 1, 2, 3 years, depending on what sort of term you look at. Now, where you see those spreads between, let's say, a call account versus a term deposit, and sort of what sort of conversation are you having with your key clients to the liability side?
Thank you, Bishan, and you're absolutely right. Whilst when the interest rates were at its peak, that's the behavior that we observed then. Lately, of course, after the 100 basis points cut that we have seen, that gap now seems to be widening a bit. Call and current tend to be higher priced in a way, and as we all know, it's not really very sticky in nature, and tends to be price sensitive. So, whilst that spreads widens, there is a tendency of customers to move into term deposits and lock in at rates that are available currently. And, I would expect this behavior, to continue as we see the rates declining. Of course, as an offset, clearly, and to avoid that kind of volatility from our balance sheet and P&L, that's been, one of our key focus areas. So you've seen over the last 3 years, the focus has been to increase the savings deposit, and that's aggressively, the strategy that the bank continues to pursue. So you're right. So there is an element of volatility in terms of the spreads between call current and term, and the behavior that it tends to drive depending on where the interest rate moves.
See, to hedge this or mitigate this increase in the deposits, I think as you have observed to the peak of the cycle or otherwise, one or two things in terms of consolidation of the pension funds, consolidation of a lot of government entities together. So the bargaining power shift has happened in the country in terms of the corporates and the banking sector. So the branch expansion that we entered into is primarily one of the main reasons is to mitigate against that and to have a sustainable reduced cost of funds going forward, which I think you saw from Vikesh's presentation that the cost of funds we were able to reduce because of this strategy. As we work hard to get those businesses in the branches in our network, our assumption or the aspiration is basically on a sustainable basis reduce the cost of funds and stay at a particular level that we are comfortable with, so that the difficult bargaining position or the change in the bargaining position does not affect in a major manner the cost of funds of the bank going forward. At a macro level, that's really what we are looking at.
Right, thanks for the answer. I mean, one last query from my side before that, credit where it's due. I follow the journey of Bank DHOFAR very closely, and as a keen observer, you pretty much walk the talk, especially when it comes to fee income. So, congratulations on sort of continuous growth over there. We've seen some phenomenal growth over there, and we're currently at 29%. Fee income ratio. What sort of more juice do you see over there? What's an aspiration number over there? If you could just comment on that.
Thank you, Bishan, and thank you for that. Clearly, we did talk about this and continues, as I said, to be a key focus areas. We did come from a smaller base of 14.5%. That was the fee to total income ratio in 2022. Now at 29%. So whilst most of my businesses, be it corporate, retail, treasury, financial institutions, Islamic banking, have started generating reasonable amount of fee and in line with the market. We did talk about some of the new business initiatives that we had undertaken or have brought into our businesses over the last 2 years, which is basically wealth management, private banking, priority banking, as well as corporate advisory businesses. Now, these businesses, asset management businesses, these businesses have started contributing, but we do expect the contribution coming from these businesses to accelerate further. So I do see some more upside into our overall fee business in the coming quarters, and we are hopeful we'll be able to take it further from here.
We have a lot more steam left.
One last bit from my side. Sure, sorry, please go ahead.
No, I said we have a lot more steam left, I said.
Fantastic. Look forward to that. We sure this. And one last bit from my side is, what would be a target or aspiration cost of risk? We saw a slight spike in Q2. You mentioned the reason for that, and you've seen sort of the journey on that book as well. What would be sort of a more optimal cost of risk sort of target from your side?
See, cost of risk, as I mentioned, and this was guidance that we had issued earlier during the year, and when we were looking at 6 quarters of elevated cost of risk. We have already, done 2 quarters, and now I believe we are pretty much at the tail end of it. Currently, we are at between 70 to 80 basis points in terms of cost of risk. I expect this to be pretty much in the similar range over the next 4 quarters. The market cost of risk tends to move from as low as 20% to 60% levels. We expect this to come down significantly once once some of these key challenges are behind us, key legacy challenges are behind us. So I do expect this to gravitate towards market and better than the market levels in the coming quarters.
See, a year from now we should be 25% lower than where we are today. Might be a couple of years we should be nearly 50% lower than where we are today.
Excellent. And this is with 100% provision coverage ratio, or say 100% provision coverage ratio?
No, whatever the IFRS models dictate and the central bank requirements, I'm saying complying with those things. I don't have a number on what's the overall number in terms of the coverage. Yeah.
Okay, got it. Thank you. That's from my side. Wish you all the best. Thank you.
Thanks. Yeah.
We have one more question from Shower.
Yes, hi. Thank you for the opportunity. I just had a couple of questions. Starting with the deposits, we've seen some tremendous growth year-over-year in the deposit base. If you're looking at it sequentially compared to March quarter, we've seen a small decline in deposits. Could you please explain about it?
Thank you, Shaur. And if I look at my March numbers, and there was a question that I was responding to earlier, raised by Bishan and Mana. That was with regards to the lower stickiness that is associated with some of the call and current deposits that we have. And there was some one-off current deposit that we had as at the end of March that essentially moved out. So that's pretty much what's offsetting my CASA. So you will see my CASA growth whilst continues to be quite healthy as far as savings deposit is concerned. That non-sticky portion of my CASA led to that marginal decline between March to June.
Right, thank you. And one last thing from my side is, although you have touched in detail on your impairment cost, we've also seen a significant surge in impairment cost, particularly in this June quarter. It went up close to 50%. And when you say that these will be normalized in the upcoming quarters, should we be expecting this current number to sustain, or should we be expecting the number that we can see in the March quarter to be in the next quarters?
Thank you, Shur. So, as I mentioned, my overall cost of risk on a YTD basis is at around 80 basis points. I would expect this to continue to be in this range, which is between 70 to 80 basis points over the next 4 quarters.
Thank you, everyone. Thank you for the presentation so far. And just a few follow-up questions on the answers so far. Now, what is on the provision coverage that you have mentioned? Said you don't have enough perfect the number, the cost of this will be higher going forward for new models. I just wanted to know if you could break on what is the trend in NPL that you are seeing. Right now we are at 4.8% PLP, coming down from an elevated level and stabilizing. But when you say the credit cost will be higher and probably the coverage ratio may not improve or not, it could improve. You said you would have enough, but you will be compliant with the regulations. So what's the trend that we are likely to see in the NPL ratio?
Thank you, Joyce, for that question. Yes, you're absolutely right. The NPL ratio, which peaked upwards of close to 6%, almost 5.87% in 2022, has since then declined to 4.75%. We do expect this ratio to stay under 5%, Joyce, in the coming quarters. Clearly, the additional provisioning that the bank continues to make should help improve the coverage ratio. But as Mr. Gopa mentioned, coverage ratio is really a function of where we are on the LGD curve, as well as the level of collaterals that we carry on our NPL book. So that's really a function of that. But yeah, in terms of our NPL ratio, we do expect this to be sub 5% in the coming quarters.
See, I think I'll go back to the previous question also about what happened in this quarter, the level of provisioning or the ECL increase as compared to the previous quarter. I think what I would like to say here is some of the provisions of the ECL that we are taking are more precautionary in nature. It's not necessary that they have been an additional classification or increase in NPA. And our endeavor is to work to solve the issues with respect to the stress in the account. If we are able to sort out the stress or solve that, even a lot of provisions that we have taken or we are taking now might become really a surplus as well. So I think I don't want to give the impression that, look, it is going to be a one-way street in terms of only increasing the provision. It can very well be that if we are sorting out the stress in the account, this a lot of provisions that we have taken could actually become a surplus as well.
That was very good. Thank you. Also, another question is, throw some light on the liquidity outlook. Your loan to deposit ratio has been on the higher side. Yes, you were focusing primarily on the liability side to branch expansion. So, what's the ideal loan to deposit ratio from a modeling perspective for maybe next year or 2 years down the line?
So, Joyce, in terms of the loans to deposit ratio, again, if I take you back to the history, just a couple of years back, which is 3 to 4 years back, our loan to deposit ratio was somewhere in the range of 118%, if I remember correctly. 103%, the current loans to deposit ratio, is something that we believe is sustainable, given we have additional savings deposit, which is really supporting our liquidity ratios. In addition to that, we very recently, I talked about the subordinate debt that the bank has raised. That also supports the overall liquidity. So it's really the mix of liquidity that has changed over the last 3 to 4 years. So that's been the focus area. And needless to say, the bank continues to focus on ensuring the regulatory ratios are always adhered to. So to answer your question for your modeling purposes, I think this is the range that you should be looking at.
Got it, perfect. One more last question, and that's to Mr. Goba. Goba, you've been continuing as the acting CEO for the last 1 year. I wanted to check, why the bank has not appointed a full-time CEO yet. Is it something internal, or is it something because of issues with the regulator?
I think there is no issue. I'm doing the job, which is what is most important is the job getting done, and I think the results speak for itself. Thank you.
If there aren't any more questions, we can conclude today's meeting. Thank you, everyone. Thank you, Chiefs.
Thank you very much to the investing community and the analysts and everyone to have taken your valuable time to be on the call. I hope you found it useful. As always, we try to be as transparent as possible in terms of providing the information and the answers to your questions, and look forward to your continuous engagement. Thank you, everybody.